All right, let's dive right in. We're breaking down the U.S. market action for Tuesday, October 7th, 2025. After 7 straight days of gains, the AI-fueled party finally hit a major speed bump. And today, we're going to unpack exactly what happened and why. Here's the game plan. We'll look at why that winning streak came to a screeching halt. Then we'll dig into the huge question about AI profits that really shook things up. We'll spotlight the day's biggest winners and losers, hear what some Wall Street titans are saying, and lay out 3 different ways you could think about investing from here. So first up, that 7-day run. It felt like nothing could stop this market. But today, the music finally stopped. The rally didn't just slow down, it hit a wall. And you can see it right here. All 3 major indexes closed in the red. The S&P 500 was down about 0.4%, the Dow was down 0.2. But the real action, the real pain, was in the tech sector. The Nasdaq led the way down, dropping 0.7%. You can basically boil the entire day down to this one slide. It was a total tug of war. On one side, you have the pure AI hype and optimism, with a stock like AMD just soaring because it landed a massive deal with OpenAI. But on the other side, you got a cold, hard reality check from Oracle, whose stock got slammed after a report came out questioning how much money is actually being made in this AI gold rush. So let's be clear, this wasn't just some random profit-taking. It was a real shift in mood. That Oracle news was the main trigger. It kicked off what we call a risk-off feeling. And with the government shutdown still going on in the background now for its 7th day, investors just had another reason to be nervous. So what did they do? A lot of them ran for safety, buying up assets like gold. Okay, let's zoom in on the single biggest story of the day, because it gets to the heart of the entire AI rally that's been driving the market all year. The question is this gold rush actually profitable for everyone involved? You hear that term risk-off all the time on Wall Street. It sounds complicated, but it's really simple. It just means investors get spooked. They sell their riskier stocks, think high-growth tech, and they move that money into things that feel safer, like government bonds or gold. And here it is. This is the number that poured a bucket of ice water on the market today: 16%. A report came out suggesting this was Oracle's profit margin on leasing out its super powerful AI servers. Now, for a high-tech cloud business, investors were expecting way more. That number was shockingly low, and it sent a chill through the entire sector. This news pretty much forced every single investor to stop and ask a really tough question. If the companies selling the picks and shovels in this AI gold rush aren't making the massive profits we thought they were, then what does that say about the foundation of this whole rally? Is it a lot more fragile than we thought? Now, even on a down day like this, you still get some dramatic moves in individual stocks. So let's take a look at some of the day's biggest winners and losers. This table pretty much tells the story of the day's chaos. You've got AMD and Dell riding the AI hype wave higher. Then you've got Oracle getting hit by that reality check. Totally separate from that, Ford dropped 5% because of a factory fire that sparked supply chain worries. And then you have the absolute wild card, Trilogy Metals. Just look at that number, 171% in one day. No, that is not a typo. Trilogy Metals, a mineral exploration company, just exploded higher. Why? The U.S. government announced it's taking a 10% stake in the company to help secure supply chains for critical minerals. Just an absolutely mind-blowing move. You could also see this shift in mood really clearly when you look at the different sectors of the market. Investors were selling those high-flying tech stocks and moving their money into defensive areas like consumer staples. Companies that sell things people need no matter what. Think soap and soda. It's a classic move when people get nervous. So, whenever the market gets choppy like this, everyone wants to know what the biggest names in the game are thinking. And today, we heard from a few of the heavy hitters. First up, the legendary investor Paul Tudor Jones. And wow, this is a pretty stark warning. He's comparing what's happening now to the dot-com bubble. He thinks we could be in for what traders call a blow-off top, that final, crazy, explosive surge, and he says it could be even bigger than what we saw back in 1999. Then we have Ken Griffin from Citadel, and he's focused on the price of gold, which has been soaring. He says this is truly concerning. He sees it as a sign that the world might be starting to de-dollarize, which is a fancy way of saying global investors might be losing a little faith in the US dollar as the ultimate safe haven and are looking for other options. And finally, Ray Dalio from Bridgewater gave some very specific advice. He sees a lot of parallels between now and the unstable, high-inflation 1970s. So he's not just talking in theories. He's saying, look, putting around 15% of your portfolio in gold right now seems like a pretty reasonable move to protect yourself. Okay, so you've got AI hype, you've got profitability fears, you've got billionaires sounding alarms. What is a regular investor supposed to do with all that? Well, there are basically three different ways you could think about a strategy from here. So this table lays out those three paths quite clearly. Path number one, you bet the AI rally keeps going. You believe the spending is real and you invest in the companies building it. Path number two, you play it safe. You acknowledge the risks are real and diversify into something like gold. Or path number three, you go defensive. You think the whole market is too expensive and you focus on stable, boring companies. And here's an even simpler way to think about it. For each of those strategies, here's a practical example. If you believe the AI rally has legs, a stock like AMD is a pure play. If you're putting safety first, you might look at a gold ETF. And if you're going into a defensive crouch, a consumer staples ETF would fit that strategy. Okay, let's bring it all home. After a day with so much noise, what's the real signal? What's the most important thing to take away? At the end of the day, it really comes down to these two competing stories. The bull case, the most positive view, is that today was just a bump in the road. The AI revolution is real, companies like AMD and Dell prove the spending is accelerating, and this is just getting started. But the bear case, the most negative view, is that Oracle's numbers were a huge warning shot. It suggests this is a bubble built on hype, not profits, and it's starting to crack. So, looking ahead, there are two huge risks you really need to keep on your radar. First is the simple risk that this AI bubble just collapses under the weight of these new profit questions and sky-high valuations. And second is the threat that inflation stays stubbornly high, which would prevent central banks from cutting interest rates and giving the market a boost. And all of this leaves us with the one big question that everyone's asking tonight. Was today's sell-off just a healthy pause in a much longer AI rally? Or was this the first real sign of a much bigger shift in how the market thinks about the future? That's the question on everyone's mind.